Look at the massive stone pillars and towering skyscrapers of a downtown bank branch. They do not afford to build these empires by collecting the pennies you save in a checking account. Instead, they construct those monoliths by taking your deposited money and putting it to work for themselves. You are likely taught a specific set of rules. Work hard, save your cash, and avoid debt at all costs. Meanwhile, the wealthiest individuals and corporations on the planet play by a different set of rules. They do not row away from banks, they partner with them. To bridge that gap, you have to separate emotion from mathematics and identify bad debt. When you swipe a credit card at 18% interest or finance a brand new car right off the lot, you are borrowing money to buy a depreciating liability. You wake up and go to work just to make the minimum monthly payment, trading your labor to pay the bank's profit. Good debt operates in the opposite direction. To build wealth, you have to stop acting as the fuel for the modern financial system and learn how to operate the bank's machinery in reverse. The access point to that machinery is your credit score. Most people only think about their score when they want a rewards card, but it is actually the foundational mechanism for acquiring serious borrowing power. Banks are not in the business of guessing who is reliable. They're in the business of calculating risk, and your credit score provides the mathematical answer to how likely you are to pay them back. This risk assessment scale shows the relationship between your reliability and the cost of capital. Notice how an increasing credit score forces a corresponding interest rate percentage to drop. The higher your score, the cheaper the money becomes. The bank stops seeing you as a high-risk gamble and starts viewing you as a safe harbor for their capital. This low-risk profile gives you the ability to negotiate terms across multiple banks, forcing them to compete for your business. Securing that cheap money is the mandatory fuel you need before you can safely start the engine of leverage. Think of leverage as a mechanical multiplier. If you try to lift a 2,000-pound boulder with your bare hands, you will fail. But if you slide a massive steel pry bar underneath it, you can lift financial weights far beyond your own cash capacity. Let us look at how this math plays out. This diagram represents a standard investing model. You take $20,000 in cash and buy stocks. If that portfolio goes up 10%, you make a $2,000 return. Now we apply leverage. Instead of buying stocks outright, you use that same $20,000 as a 20% down payment. The bank steps in to cover the remaining $80,000, allowing you to control a $100,000 asset. When you prove you can handle this leverage, the banks will start chasing you. They will offer massive lines of credit, which creates a dangerous temptation. This is where people fall into the debt trap. They take their access to capital and apply it to their personal lifestyle, using it to fund a kitchen remodel or a month-long vacation. Borrowing for consumption breaks the mathematical model. That vacation creates a liability, but it produces no income to service its own debt. You must treat your borrowing power as capital, reserved exclusively for acquiring assets that produce their own income. You ignore the luxury SUVs and instead acquire the gritty, unglamorous machines that print money. To scale your wealth safely, you have to build an ecosystem designed to withstand unexpected economic downturns. The primary safety valve is a moat of liquidity. This graph maps a fluctuating income line dipping below a flat debt service line. By holding 6 to 12 months of cash reserves, you create a liquid reserve that fills the gap, allowing you to cover bank payments during dry spells. Your secondary safety valve is locking in long-term fixed-rate debt. As inflation drives up the cost of goods, your fixed mortgage payment stays the same, becoming cheaper to pay off in real terms every year. You evolve from a transactional consumer into a strategic partner who makes lending institutions compete for your profitable deals. By mastering the underlying math, mitigating your risks, and deploying capital into true assets, you stop trading your labor for money. Instead, you build a system where your assets generate the capital to sustain and expand your holdings.